Welcome, everybody, to the Build, Buy, Sell panel. I am your moderator, Charlie Ryan, Senior Vice President at Hunter Hotels, focused on debt and capital markets. Joined here by my four esteemed panelists. I'll have some quick intros.
Yes, good afternoon, Dustin Fisher, Senior Vice President of Acquisitions at Noble Investment Group based here in Atlanta. We are the sponsor of a series of closed-end funds focused exclusively on the lodging space. We are currently deploying Noble Hospitality Fund 5, which had its final closing in December of last year with about $1 billion in total capital commitments. Looking back at the activity of the last kind of 24 months, we've been fairly active. I think in contrast to a lot of the broader market, we've done roughly $1 billion in acquisition and development activities. That includes acquiring 13 hotels last year. And I think, kind of despite some of the current dislocation we're seeing, we'll never really find ourselves out of the market entirely. For us, it's about proactively identifying markets we want to be in, specific assets we want to own there, letting our access to capital be a resource and solution to owners that might, be in need of, remedies in various situations, whether it be renovations, partnership distress, loan maturities, and then adding incremental value through operational or physical value add to help mitigate what's otherwise a kind of lackluster cash-on-cash return environment. So while I think we kind of sleptwalk into first quarter of this year, I think with what we've got under control now and some of what we're kind of bantering back and forth with things under agreement, we're hopeful for a fairly robust transaction activity here into the second quarter and into the second half of 2024.
Hi. Sorry, I had to figure out the mic here. I'm Crystal England. I'm Chief Investment Officer of TMGOC Ventures. We are a Southeast-based owner and developer of hotels across the chain scale. We generally will acquire in the select service kind of space for value-add acquisitions. And for development, we've got a focus on, lifestyle hotels kind of across the spectrum, whether they be our Thompson in Charleston, Ritz-Carlton in Savannah, or existing Moxie's in Charleston and Charlotte. So we've got a $1 billion portfolio, primarily focused in the Southeast United States, although looking to expand that out to the Mountain West. And we are kind of headquartered between two offices in Charleston, South Carolina, and Boca Raton, Florida.
Good afternoon. Mike Wilbert, Senior Managing Director and Head of Acquisitions for Mission Hill Hospitality. We are a Denver-based private equity fund. Our parent company, KSL Capital Partners, launched Mission Hill 3 years ago in March of 21 to invest exclusively in select serve, extended stay, core branded hotels across the U.S. In the last 3 years, we've acquired 33 assets, some in single asset acquisitions and some in small portfolios. We work with third-party operators and look to grow the portfolio through single asset or small portfolio acquisitions in the next couple of years.
Good afternoon. My name is Mehul Patel. I'm based in Dallas, Texas, and we're a little different from all my colleagues here. Primarily, we're a hotelier also, so we buy, build, sell everything we do. We also have a bank, American Bank, based in Dallas, Texas. We have a debt fund, alternative investment, and public equity. So we're kind of spectrum in all 5 different silos, but our focus is also in hotel heavily. Last year, we bought 83 hotels, and this year, we're tracked to close about 90 hotels. So we're very active in buying large portfolio, and any given time, we have 50, 70 hotels. So we like to buy portfolio, repurpose into different brand, change the segment, or repurpose the land, or do something with it. So we just like the real estate space, and then the hotel comes second phase. So we're just interested in real estate and then figure out what to do with the real estate. So that's been a post-pandemic kind of our business plan. So we've been very active on buying a lot of hotels.
Great. Well, thank you all for being here. So build, buy, sell. We'll start with the top and walk through building. It sounds like everyone here is actively looking to or currently in the construction phase. We all know the challenges with interest rates, costs. What is it going to take to really, I don't know if anyone joined the last session that just concluded, but supply growth is muted significantly. What is it going to take to get construction growth back on historical pace? Open it up.
I'll jump in there. I mean, I think that from TMGOC's perspective, we love the fact that supply growth is muted right now. We've got a number of, I think, really transformational properties that are under construction right now. This one being our Moxie in Charlotte, and then a couple more that we're going to look to start to break ground on this year. And that's really, for us, it's a product of timing. We've been working the last several years on getting, two very large projects kind of through pre-development and ready to break ground on. That'd be our Thompson in Charleston and the Ritz-Carlton in Savannah. And for us, I think that, while nobody really likes the interest rate environment right now, certainly not us, certainly not for construction, all of that being said, I think that it's generally our perspective that, the interest rates right now aren't going to kind of make or break the deal. And the time is right for us to be kind of working through and delivering new product a couple of years from now. So we really like that we really like kind of where we are right now, but for kind of the cost aspect of it.
Sure. You want to add something?
Yeah, no, I think an important differentiation. I totally agree with everything Crystal was saying. I think what you're seeing on the supply growth side, somewhat, sitting in the fund model seat is just very complicated in a levered, levered hold model. We're building. We're always building, but I think we have 3 hotels under construction right now in kind of the core select service space, and then we'll break ground on 15 mid-scale / economy extended stay hotels this year. Those are really the culmination of a long incubation period, right? Where we're kind of mitigating the impact that would have on a fund IRR right now. But it's just too. You just can't ignore what the discount to replacement cost opportunity is right now. But that's kind of our headset right now. So while we're incubating new development for future funds, I think we're probably part of the catalyst for this muted supply growth because a lot of our resources have just pivoted to buying at discounts at an opportunistic point in time.
Sure.
I think from my perspective side on the construction side, it's going to be really choppy, right, for foreseeable future. I think the cost will never come down because of, everybody talks about, once the labor goes up, it never comes down. That's a fundamental issue. Raw material has also gone up, and it's never going to come down because the people who are building raw material, their wages has gone up also. Who does transportation, provide all the raw material, their cost has gone up. So when you look at the factor of who's the raw material, who's the supplier, who's the distributor, and the labor, all segment has gone up. So I don't think we're ever going to see foreseeable future the construction cost ever going to come down. So that's the one issue. I think that's a new norm. We would have to at least understand that. Second issue with construction is time. We used to build in 14 months project. That is 20 months schedule today. All the municipal cities are not prepared to do the building permit. It takes longer time for them. And building time has taken 6 more months. So when you factor in project cost, if you talk about luxury project, the 6, 8 months, 12 months, the construction interest rate project has gone up. So all your project cost has just gone up because of the timeline. And if you're lucky, if you can get that done on your schedule. So that's a major challenge. And I think the last factor is today, because we own a bank and we have debt funds, so from my perspective, the lending community is also very cautious that everybody talks about CRE, debt is in trouble, and a lot of the bank don't understand what CRE is in trouble. Is it office, hotel, multifamily, all that segment in one bucket when you talk about CRE. So everyone has that stigma that should I be lending on a new construction, a new lending today, right? That's the one issue I see it. But then the major issue is all the brands I talk about it. Every segment is not, you cannot build ground up construction. That is an issue on it. What product should you be building in today's environment where your cost is so high to build? Whether you build economy, mid-scale, lifestyle, luxury, they all cost same. The elevator is same cost no matter what brand you build. AC, Courtyard, Hill, whatever you name it, every washer, dryer, technology are the same. So at some point, the fundamental cost is the same in no matter what segment you build. So I think all the developer has to define what segment can I build in feasible in today's environment, right? It's not that you could just wake up and build economy or mid-scale or whatever. So there is economy of scale building the right segment in the right market, then you could get a deal done. So I think the construction and development has just become very complicated just to understand. And there is so many layers if you go through it. So there is ample capital out there, but you have to understand your business model that can I be building this hotel and does it make sense? So that's just my perspective.
Sure. No, appreciate it. You touched on certain markets are more challenging than others. Is there an area of the country that you're focused on today where the red tape is a little less than others? Whether it's a pocket, a certain market, a specific city?
I think all the markets are just moving, right? You think LA is good, San Francisco is going to be good in next 5 years. New York's good today, but things are changing. So I think, we often talk about red and blue states, right? So it's given, definitely you could see where you should see the prosper, what's happening in the market. I think the labor union states are getting very challenged, right? When we were at ALS, people were picketing on Cambridge, whatever. So that has become a very scary factor, what's happened in a different market. And so I think that's a bigger fear factor today. Where do you go? I'm from Texas, and we said we've always been a red state, and the blue states are moving in our state. So hope our state doesn't, turn. So we've been very cautious on it. So, Austin has become that stigma that Austin has, the demographic has changed, and does that change our business model, how Austin has been, and does that change? So that's where the fear factor happened, right? Nashville has a lot of people moved in. Florida has moved in. So Southeast had so much windfall happen. So I think the investment cycle is also getting very narrow. Where can you go and invest, right? There's always 10, 15 states you could go. The rest of it are also good. Chicago, everybody talks about it. It's been a good, but the labor, the property tax. So when you talk about every state has their pros and cons on it, but end of the day, you got to find your comfort zone that where can you feel comfort that it's a long-term investment or short-term investment.
Right. It works for your model. Absolutely.
Well, one thought on that is when we are looking at a market or geographies to invest, we're defining it as business-friendly, labor-friendly, and following the migration patterns. And as Mike shared, in the last couple of years, it's Southeast, Texas, Arizona, and Mountain West. So for us, that's where I think we're spending most of our time today. And then one last thought on the development side. Mission Hill is not a developer. We do not have that capability in-house, but we are working with groups, institutional and regional developers who have track records, who are building the products we want to buy, and we're getting traction with them on forward takeouts where we sign a contract early on, they build it for a guaranteed maximum price, they deliver in 24 months, everybody walks away hopefully happy, and that's something that we think allows us to help the development pipeline for some of the groups that may need a credit enhancement or some form of guarantee or a deposit. But that's something that I think is valuable for the brands when they're issuing new licenses and franchise contracts to say, okay, you've got the development capability, you've got credit, and you have the end buyer all lined up from the start. That's how we're seeing more projects get completed.
Great. So you brought up the brands. So let's move down the life cycle of a hotel. So we have construction, we're building. We think there's an opportunistic moment here for some of us to build. Been hearing a lot about PIPs lately. PIPs. Post-COVID, a lot of PIPs where the can was kicked, delayed a year, 2, 3. It feels like the bill is due now. How are you individually, your groups, working through the PIP conversation? Are the brands being flexible? Is that a motivator to sell and to not have to deal with it? Love to hear your thoughts.
Yeah, if you mean specifically on the kind of change of ownership side, well, really any typical life cycle or the change of ownership side, that song has stopped. The kind of the blanket deferral, if you will, that takes place, which we've seen take place after several industry crises. We're kind of in this lag period. You get this grace period, 3 to 4 years. Same thing happened after GFC. There's kind of this layoff period, and then actually a more robust, kind of counterintuitively, you would think the buying opportunities are immediately after the kind of crisis event. It actually takes 3 to 4 years, and a lot of this PIP, the deferred maintenance and PIP, is really the catalyst for that. And if you look back, I think at Noble's track record, our most fruitful years were really 13, 14, 15. So if you use the transitive properties, albeit a slightly different capital markets backdrop, we're getting to the precipice of that right now. So unless you have the product quality to justify it, that music has stopped. And the brands see it. I mean, they've seen the recovery, they see the asset performance, and often at the expense of product quality. So we expect that the forcing of the hand on the brand and deferred maintenance side becomes a major precipitator of transaction activity this year and next year.
Okay.
And I would echo that sentiment. I think on our side, I think where we're, as I mentioned, we're focused on kind of value add acquisitions in the select service space, and a lot of that, what we're seeing, those opportunities are coming about because because there's a substantial PIP involved, or because there's a substantial renovation that, it's coming due again, regardless of the property performance. And I think that kind of while, I would say that while if you're an owner and you've got a PIP coming up, you've probably got a little bit more negotiating room on that PIP than if you're acquiring a property and you've got a change. Then there's a change of ownership PIP. I think the brands are really kind of taking advantage of that transaction, activity in the market, and generally not in a bad way, but taking advantage of that to kind of get the kind of full scope of the PIP that they otherwise might provide a little bit of relief on to an existing owner.
Great.
I'd say from the underwriting side, what we've developed over the last 3 years is sort of a tiered process to pricing change of ownership PIPs. It's what's the estimate from the seller or from the broker or from the current ownership group. Then bid it out to 2 or 3 third-party CapEx consultants during diligence, and then before close, work with the lender and the PIP consultant to make sure everybody's on the same page about what this is going to cost either day one or in year 3. We've learned over the last 33 hotels that it's not 12 a key or 15 a key anymore, and there has to be contingencies from our side, from the lender's side, and from the CapEx consultant who's actually going to do the work. But I don't see that changing anytime soon. In terms of the brand being very strict and holding everybody accountable for what they set out to do. We've seen some success in deferred items, but not what it used to be during COVID.
Okay. Well, thank you all.
It is kind of Mehul's point too, where everything is more expensive and it's not getting any cheaper.
Yep.
Yeah, I mean, I think we'd look at 7-year renovation. I often say that hotel industry cannot justify 7-year renovation anymore. It has to be 10, 12 years before you could do even soft. Like when you talk about drapery, artwork, lamp, that cannot be a soft good renovation 7-year, because now if you look at 14-year PIPs are costing $60,000. And so how do you justify that investment? And it's just not feasible, and time it takes, right? That when you do 12 months, that 14-year renovation takes you 9 to 12 months to finish it. You still lose occupancy, you lose money on it, and then it costs you more, and then you don't even know how much you got. You may maintain the business, but not sure you're getting ROI on that investment. That is the biggest factor today. Even 7-year renovation, you may maintain the business, but not getting ROI on it. So your DCR, IRR is going to impact on it. So that is the biggest challenge for hotel industry. And now let's say your debt may be CMBS or whatever debt you have it, or even fixed rate, you're borrowing at 9% or 10% rate to do a PIP on it. And so that number is hard to begin with it, it's expensive to begin with it, and time it takes bigger rate. So it's a bigger challenge to deal with that PIP issue, and we just have decided not to play in that segue. Either we build or we sell. We're not in the middle of it. It just become really choppy, and it's just gray area for us. Is not sure if I'm going to get the ROI on it. So we just feel like sell or just build new one or something like that.
Okay, great. So moving through again, we've build PIPs. Now we're getting to the acquisitions. We're all super active, looking to deploy capital, buy new assets. Post-COVID again, it was extended stay, drive-to locations. That was everybody wanted it. Has that shifted significantly today? Is urban coming back? Is luxury appealing to you now? Walk us through kind of your thought process as you're looking at new acquisition opportunities.
Yeah, I think the recovery has been so, it's difficult to quantify in any given market, any given segment within a market. So you talk about urban, you might look at urban Tampa, really well recovered. You look at urban Philadelphia, still a long way to go. So rather than look in segments of drive-to leisure, urban, airport, what have you, we really divide it into two camps. It's yield and without yield. If you have yield, you have options, whether that be through the capital markets or through a sale process. The bid-ask spread for me is, at least at Noble, is still 10 to 15% there. We've seen kind of high net worth and REITs backfill that space, rightfully so. When levered buyers and PE are kind of out of the market, that's not really for us. It's the broken stuff without yield, because for us, not all cap rates are created. We use cap rates rather flippantly, I think, in this industry, but not all cap rates are created equal. So where can we go add value? That's really where we're spending most of our time, wherever the location might be, whether it be urban, tertiary, secondary, really doesn't matter. It's can we go create yield that doesn't exist today? And for us, that's getting proactive. It's in front of renovations, in front of maturities, in front of partnership distress. There is a lot of partnership fatigue out there that exists for deals that are 7, 10 years old. They just want their money back. And how do you go be a solution for that before it ultimately comes to market? We do a lot of our work off market, so it's trying to identify where those stress points exist and capitalize on that rather than say, all right, Noble's vectoring hard, urban right now.
And I think I'd echo that sentiment as well. I don't think that we're not focused on any one particular chain scale or segment. We are opportunistic. As we're doing everything from extended stay America Suites in Jacksonville, all the way to Ritz-Carlton. So it just depends on the opportunity that's there. But for us, it is limited by geography a bit. We are we've talked about kind of the Sunbelt states and those being kind of target markets. I think for all of us, we're very much in that camp as well. We see that kind of attractive from just a kind of generally from a labor standpoint. And for us, if you can get projects going in high barrier to entry markets where there is a favorable labor environment, that makes for a really kind of interesting profile for us. But I think that again, we are focused more on where the product is and kind of what the specific nuances of that market or of that location are, as opposed to kind of whether it's economy extended stay or mid-scale or luxury.
Yep. Mike, has the interest rate environment or the elevated costs shifted your strategy in any way?
No, it has not. It's certainly slowed down our growth, but we're staying disciplined to continue to invest in select serve and extended stay. One thought on what Dustin shared in terms of the catalysts for somebody selling today. Even when we have an inbound or we're speaking to somebody about a deal, the first question I ask is, why are they selling? What's the seller's motivation? What's their timeline? Are they real, or are they just opportunistic? And if somebody hits their number, they will move on it. Understanding that part of the equation is, I think, going to get to the end result faster. Then in terms of the bid-ask spread, again, Dustin shared in the interest rates, we're seeing 20 to 25% going call it a first-round offer, starting at that 20% off of guidance or off of their expectation or off of ask. I've talked to peers in industry, and that seems to be across the board. And then what we are working on internally is, how do you bridge it? Are we creative with the seller staying in a joint venture? Is there a mezz position for the seller or for another lender? Is there an earn-out structure? We've had success doing this. We think it's a path forward to kind of bridge from 20% to 5 or 10, and then both sides have to eventually meet in the middle.
So we're all buyers and sellers. So who's at fault for the bid-ask spread?
Everyone.
Brokers.
I would say everyone. The broker, the seller, the buyer, everyone's at fault.
Wonderful. And how are you guys buying these assets? So, Mehul, you mentioned that some groups have lines of credit, so your relationships are there. Have LTVs been significantly impacted? Are these all cash acquisitions? You're refinancing after the fact. How are you getting creative with the environment that we're in?
I think it's all over the board, right? What are you buying? If you're buying a portfolio that has a big capex, that number change on LTV, right? Lenders like, if I deploy this capital, are you going to recap that? Would that DCR come back after you buy? So I think the LTV has compressed. 65 is the new norm, I would say, when you go talk to him. It starts at 65 and then maybe taper down to 60 or sometimes 65 with additional collateral. Like at our bank, somebody said, could you do 75? We said, we'll do 75%. We'll do 80, but with additional collateral, we may ask CD to pledge. So there is ways of doing it, but end result is still 65. There is no other way to get around with it, right? You could ask CD, MEZ, whatever you talk about, additional collateral, all that stuff, but end of the day, it's 65. And I think the LTV doesn't really matter if your property has to cash flow. If you have a cash flow, then that LTV really mute point at that. Lender can go up to 70 if you have LTV. If your business model is clean cut, then it's not an issue. But if there is a hair on it when you're buying from seller and the seller P&L doesn't reflect, the GOP NOI doesn't have a lot of fat on it, then the lender has to get convinced that you're able to turn around with a new management team, and how quick can you turn around? That's the other issue. And I think, look, all the lenders getting a lot of stress with the OCC and their regulators because they want to make sure that you have a good portfolio that you're lending on it. And if bank has a trouble, then it's all the trouble for everybody. So I think everybody's just trying to manage the risk.
Any material different responses on how you're financing acquisitions today?
Nope. I think it's a good cautionary tale in why you manage relationship lending. It's for times like this. I think all of our transaction activity right now is with truly trusted groups that, while they might be shut off to a broader part of the market right now, still believe in the track record, expertise, the brand that you cultivate. We all could have financed hotels with our eyes closed in 2021. It's what happens, when you're in a dislocated market like this. So, very thankful that that we have that, and it's something that everybody should take note of for why it's cliche, but why you invest in relationship banking for times like this.
Absolutely. Okay, distress. We all like to say there's going to be so much distress out there. There is so much distress out there. Who here is seeing distress? Walk us through what that distress looks like today. You read about it, you hear about all these bank loans coming due. Is it actively being sought after? Are you scooping up opportunities? Who here has transacted on a truly distressed asset in the last 12 months? We've got one.
I think we'd
Mehul
love.
bought 83 hotels last year. Not one was distressed.
I think I paid fair value. There was no distress. I think the word should be taken out, distress. That's kind of a curse word in our industry, I would say. Because the seller has to win and the buyer has to win. That's the only way transaction happen. If you think that you took advantage, I don't think there is a buyer and seller win, right? End of the day, everybody's in business to make money or at least survive or have it. So every time when seller sells something, if he's not winning it, there is no transaction. Let's be real. You could talk about bid, ask, everything. Mike talked about, what is the seller's motivation? Either he's just tired of the business or he's not getting succeed. That's the reason he wants to sell. And if you can get closer to his expectation or he takes back something, nobody wants to go home at 5 p.m. and losing $2 million deal and he's going to sell that. How does he feel, right? That never works. I always tell every time deal, it has to be a win-win. And that is, take out the distress word of it, and that's the good deal for both sides of it. So go to a deal side, and it's a negotiation tactic both sides, but you got to find win-win both ways. That's the only way any transaction would work. Yeah, once in a while you may get a deal that you got a good deal on it, but if you can find more of a win-win deal, and that's what the success of Newcrest Image. We bought and sold 300 hotels so far. We're in marketplace, our name stands out. We're a good buyer and good seller. Both sides we represent very well, because every time we sell something, we want buyers to be very successful. They can buy from us. And every time we buy something, the buyer wants to sell or seller wants to sell us more, vice versa. So I think that's a true success of buying and selling, in my opinion. Just you got to find a win-win regardless what you do.
Well, I think you look at all of us up here, and not one of us would say that we're not a buyer these days. And I think it all just depends on price. And that's just economics right there is what, there is capital available to buy, and therefore there's not a huge amount of distress. And so, while you might find different values today than existed in 2021, of course, and lower values, there's no, so long as we up here and a lot of you guys in the audience are buying, there's not going to be this kind of dislocation that causes the distress.
I agree with that. The backdrop for, I'm sorry, if I used the word distress, is if there's not available capital on the credit side or the equity side to continue to push up value. If somebody wants or needs to move on from an asset, there's going to be 15 people that show up and say, I'm a buyer or I'm a lender, and that's going to help support the value. So we haven't seen it in the products we want to own. Everybody's seen a flyer or two on a deal that, wow, that looks like a steal. That's very discounted. But do you really want to own it? That's for debate. But to predict the windfall, at least in the products we're looking at, that branded, have strong cash flows, newer vintage, decent markets, I wouldn't expect that from our side.
Mehul had the perfect characterization of it. It's finding fair market value, and when do you finally capitulate with the value you had in your head 18, 24 months ago for what this hotel was worth. And you're seeing it now, I think, on the institutional side. The groups that are capable of making unemotional decisions just on what value is now. And to Mehul's point about putting capital into hotels, will I get an ROI on it? Refinance is up. Is this a prudent use of my capital? Should I be thinking data centers, logistics? Why am I talking about select service hotels and contributing additional capital? That is happening right now. That is the dominant source of volume in the transaction market right now is some of these legacy kind of institutional groups, and that's I think normal. That's normally the leading edge of what's kind of a more robust transaction period. You see it first out of the institutions, and I think it's happening now, and I think we'll see it happen throughout the rest of this year with them first.
There's one interesting the vehicle that we created. We bought all this hotel and we created a debt fund of our own. So when we were selling hotel, we provided seller finance. 30 years ago when I got in the business, every hotel I bought, the seller finance did it. There was no banking. So we kind of brought that model back. So when Newcrest might sell, we provide seller finance to say, we'll give you 12 months financing. All the third-party reports are done. So you don't have to spend any money. Just bring 30% down. We can close in 30 days. So we were able to move our inventory faster than anything else, and they got their financing. So that was a really win-win for us. I think in our business, it's all about relationship and how can you make transaction easier, right? And so not every company is able to do that. We were fortunate enough that we had an ability to create our own debt fund. So it's about $400 million, and it's revolved every 12 months. So that was a one factor for us that, we bought a hotel, but when we were selling it, we're able to provide a seller finance over 12 months, and that was able to move the inventory faster than anyone. And it made job very easier for buyer and seller to transact, and the buyer was able to pay us a little bit premium because he didn't have to worry about the debt, and it was day one non-refundable, close in 30, 45 days, just a franchise transfer. That was only item because we took out all the risk for them. So I think in today's you have to hustle and work differently, not just pre-pandemic, call for offer, all that happened, but then there is the other transaction barrier that comes on it. So I think everyone has to just find their own comfort and think outside the box a little bit more outside today to get a deal done. And we've been very successful doing a lot of deals, but it's not just what we did last 12 months ago that's different. You have to think next 12 months. You have to think a little differently because the challenges would be different in 12 months.
Yeah, it definitely takes a little more hustle today than it did a few years ago. It's a creative solution, the seller financing. Okay, one of the panels yesterday, there was a comment made that the back half of this year will see a huge uptick in transaction volume. Are you guys buyers on that notion? Is there a catalyst are interest rates really going to go down three cuts this year? It was just announced right before this panel. 3 rates are projected, 3 rate cuts. Do you believe that? Do you believe the back half of this year is rosier than the front half?
I think that we're all hopeful that the back half of this year is going to be rosier than
certainly
than
last year. Is there a
last
catalyst?
Look, I think that it goes back to kind of capital availability in my mind. I know that we certainly have been sitting on the sidelines longer than we'd like. And I think that there's a lot of folks that are in the same position. Folks want to put capital to work. I'm not going to prognosticate about like the number of rate cuts that we're going to see because 3 is certainly a very different number than the 6 that we were hearing in January. And so I think it's equally likely that there's 3. It's, there might not be any, and you got to be kind of prepared for that reality. But I think that certainly we're hopeful that kind of bid-ask gap narrows towards the back half of this year. I think that for us right now, we are seeing opportunities that we're actively bidding on and that we're actively underwriting. That being said, are we coming to within 20% of broker guidance? In some cases, maybe, but not much closer than that. And so I think that kind of we're hopeful that we're all taking steps towards a more liquid transactional environment towards the end of this year, but that's kind of still TBD.
In my opinion, I think hope is not strategy, I would say. I'm not hoping for rate cuts, anything. If it happened, good. But anything we buy, we underwrote whatever the rate is today, and that's for duration. When we bought, the rate were lower. We never thought it's going to be there for 20 years, right? So I think it's a very cyclical. But if it happened, there's so much headwinds, right? You have election looming around, what's going to happen, geopolitical issue, world issues, and then all this stuff going on. But if you can, any transaction you do, if you can survive based on your current rate, that should be a business plan. And everybody talks about if the rate goes down, are you going to pay more to seller? When the rate went up, seller still wants the same price. The price didn't jump back and forth, right? So even if the interest rate drops, what's going to happen? Seller's not going to say, I'm going to lower my price or increase my price, or they're going to sell at that price, right? So I think interest rate is a major factor, how we do transaction. But the seller behavior doesn't change to say, okay, rate went up, I'm going to lower my price. Rate went down, I'm going to charge more, right? So it's whatever the fair market value would dictate on a transaction, in my opinion. Yes, we're all hopeful that rates should go down, but there's so many factors that to happen. And I think as long as the unemployment stays low as what's happening right now, it's very headwinds because everyone has a good job. Unemployment is low that we've seen it. People are traveling, which is a good thing. And the economy is fundamentally very strong. So how do you navigate through that, issue? So things, interest rate, we're never going to see 5 and 6% very short term. I think it maybe drop 1 point, but still interest rates going to stay there for seeable, maybe 24, 36 months until we see, a lot of stuff get corrected.
I do think we're watching CMBS as kind of a escape hatch for transaction activity, which otherwise I think would have prompted a lot more kind of distressed sales into this year. If it's as robust as how it's starting off this year, it ticked under all-in 7 in January. That's really meaningful, both on the SASB and the conduit side, because conduit side is open to a wide spectrum of borrowers. If that becomes the case, while I totally agree with Mehul's point, just the environment of buyers grows, and by nature, I think of the environment of buyers growing, will kind of spur transaction activity. So if that continues, it ticked back up in February, but I think if that momentum continues because hotels are providing such an interesting yield component in CMBS, the structuring of CMBS transactions, it could be a major catalyst for the second half of 24.
Agree. There's capital out there. Okay, we've got just about 5 minutes left here, so just some closing remarks. We just hit on what we expect in the back half of this year, opportunities. Everything's getting more expensive. Timing has never been a great strategy. Hope has never been a great strategy. Are there any significant tailwinds that are going to push you closer to reduce that bid-ask spread? If rates stay the same, if costs stay the same, everyone's continuing to travel. What are the tailwinds in our industry? What can we all look forward to?
Well, we mentioned it earlier, but low supply, if we're all tracking the thousands of hotels that are in pre-planning, planning, final planning, fine. but what's actually going to get built in this environment, I think will stay muted. So I think that's a great tailwind for anybody who has an existing hotel or who is shovel-ready and has all the capital stack ready to go for it. So I think that's one positive for us. And then going back to interest rates and the election, I think for the second half of the year or going into 25, if I think people are just looking for clarity and stabilization, right? If you can underwrite and you know what the rate's going to be for the next 12 to 24 months, then that gives you conviction in the underwrite and you can lean in and believe in your numbers. If we get through the election period and then there's clarity on administration, then guess what? You can put that in your business plan and have a better underwrite. So I think those things working out in the next 6 months will really help the transaction volume for the second half of this year.
So more stability. Yeah. Any differing opinions? Dustin?
Nope. Look, I think we're operating with more visibility than we've ever had, and that's good for buyers, good for lenders. So it's easier to underwrite now than ever, albeit more difficult because of the capital markets dislocation, which I think just comes back to at least I think most of our core competencies here, which is how do we find value outside of just pure yield plays. The election does kind of make me nervous. I can see a scenario, and not about who wins or who loses, but I think tend as an industry to latch on to mile markers where if we don't like the answer presented to us, whether that be an opinion of value or you've run a process, all right, let's just wait and see what happens with the election. I think that's slightly misguided. I don't ascribe some kind of secular tailwind that takes place regardless of who went, maybe in Washington, D.C. based on an inauguration, but not necessarily nationwide. So I'm hopeful that's not a dampener on the second half.
Mehul, any thoughts?
I mean, it's simple. I think I heard last 2 days people were like, hey, I'm losing occupancy. They're tapering the rate. I think that's a wrong movement. I think we as an industry seen inflation. I think industry should really focus on driving the rates because the inflation has really insurance, property tax has gone up, labor. So I think as all the owners and all the management company do is don't be fear of raising your rate. Just you have to maximize your property and don't drop the rate. I think that's a successful way we could navigate. If you drop 2% occupancy, what's going to happen? Don't just lower your rate because you soften the occupancy. But only way we can navigate through is many other industry has done it is increase your price, charge for what you need to do, and maximize your revenue. That's the only way to navigate through our issues that we're dealing with, the compression of margin, right? Each conference we're going to talk about margin compression. And that there is no solution if you don't fix the top line, right? It start with the top line, then bottom line you could fix it. But if you don't fix the top line, there's no way to fix the bottom line. So I would say the fundamental change we could all work as a unified group is to raise the rate, charge for parking ancillary, parking, breakfast should be more, sweet shop would be more price, F&B should be more price, and we're part of inflation also, but who taught us property tax insurance? But that's the only way we're going to fix the industry, right? You're always going to be issue. And if you are a seller, you have to have a good P&L for you to sell your property, right? Otherwise, buyers always wants the discount. So you have certain control that you could fix on your own by proper rate revenue maximization. That's the only way you're going to win and navigate through next 12, 24 months.
Yeah, but your broker is telling you that that's all upside for the next buyer. So that's why you should be asking next time.
There's always a room for everyone.
Crystal, any final thoughts?
No, I think I think from certainly from our perspective, I think that we're all business people, and I think that we're all kind of optimistic about this year and about kind of this year where it stands relative to last year in terms of transactions and opportunities. I know that certainly at TMGOC we are, and I think that we're looking forward to a strong 2024 and certainly going into 2025 as well.
Great. Well, thank you all very much. Really appreciate your time today, and thank you all for attending and being here today.